Hello everyone, welcome to today's session. Let's jump right in and get underway here. I'm going to start out with this initial page here showing the sentiment tab. When we focus on, or when you click on the market trend tab and then go over here to sentiment, it's going to pull up this list of main indices, as well as some different assets like bonds, as well as some commodities like gold, natural gas, and some currencies as well. These drop downs have the different commodities, and these currencies do as well. Now, every one of these currently is based off of an ETF type of pattern, or to be able to trade some of this utilizing an ETF. I'm going to get into that as well, on utilizing ETFs to trade around market conditions as well, for directional type trades like this, where we're looking at maybe a market bottom or a market top and be able to diversify that way. But let's look at here, S&P 500. Now, when we're looking at this indicator, sentiment indicator, we're just looking at the extremes for the most part. We know that the 50% level also right here, this halfway line, when we're continually above that, oftentimes it will retrace back down, find some support until it breaks through that, and then it comes back up. This isn't quite halfway, but it'll start to find some resistance. It'll start to find some support once that breaks down. So now we're on the bottom side of that as well. So we're at the upper ranges and then bottom ranges. These are telling areas where they're extreme, and typically markets do not continue, at least without some kind of a pause or some kind of a bounce before they continue the overall direction. So we're in that area now with S&P 500, and we're at the opposite of that with volatility. So with volatility, we would want to see it something like this, where we're seeing volatility towards the upper end of the range, because we want to see selling in volatility, meaning it's gone too far, it's too extreme to that direction, and it's going to reverse. And typically we will see that volatility here, and equities at the bottom. We're also seeing NASDAQ. NASDAQ was just really low. It says 0 right here because it's just all the way off the reading. It fell so hard in that last couple of days. If we take a look at those market ETFs, when we look at the Qs here, you can just see how aggressive that selling was on NASDAQ, really the last 3 days, and then we're down here at some of these levels also. So we should see that continue to find some support right here. Now, the question is going to be on some of these counter trend moves. Well, let's jump back. Let's kind of do a full market recap. Direction alerts is showing bearish in a bull market. Again, the way to interpret that and understand that is the bull market part of that is this upper trend, okay, this long-term trend. This is the 20-year trend of the S&P 500. And we have bear markets along the way, and we have some that don't materialize. They start as a downtrend and then they reverse. Because this is a momentum trend following system, we're looking for reversals to happen. And when they don't, and when they switch back the other direction, then we jump right back in and go back the other direction here. So we really only have had one sustained downtrend in the last 20 years. This was COVID. It was short-lived, sell-off, rally. We had that big run-up. We had the retracement of a couple years ago, and then this is where we're at now on S&P 500. That's the bull market. Now, the bearishness inside the bull market is this current trend here, where we've been retracing. So we're in this uptrend and we're bearish now. Part of the reason why it's bearish in that bull market is because we don't know if it's going to continue to move lower, or if it's going to start to find some support right here and then bounce higher. And some of these other indicators can also give us additional confirmation to say, okay, momentum. We know that when momentum, which is this red line right here, when it's deeply oversold to the downside, that's not sustainable, but it typically leads both to the downside and the upside. So here you're seeing leading to the downside. Here you're seeing leading to the downside. So if something else leads to the downside, then it's typically something different is happening. It's usually momentum that's leading. Once we start to get that, if we start to get breadth that starts to weaken here and here, and momentum starts to work its way back up, then there's a bottoming process starting to happen. So right now it's just, this is a pretty normal looking view to where we have momentum and breadth falling and sentiment not even close to falling. Okay, that's still bullish because we still have people believing in a rally. They're still believing in this uptrend, and this is just a deep retracement within that overall uptrend. Typically at market bottoms, sentiment's going to be all the way down here. Nobody wants to buy. Everybody's scared. Everybody's fearful. Okay. Whereas, and that typically is our market bottoms. Market tops are everyone's complacent. Everyone is fine. Everybody's continuing as is by the bottoms. There's that still is in play. That buy the dips or buy retracements or buy into retracements is still the current trend. That being said, only because of extreme right here. Now, what has changed is because of the length of this rally, the range or the location, this 21 right here, we're sitting at the top of that. That 21 number is this upper number, and that's going to help us with our allocation. That's going to say, all right, we're at 21, 22. This is as high as this ever gets, meaning this right here in this uptrend. And you can see in the last 20 years, you know, how many times we've had some kind of a real long drawn out uptrend. They do happen, but they just don't last forever. And in most of the history here, they've ended pretty nasty. Sharp sell-off, couple of sharp sell-off here, longer drawn out bear market versus a retracement, but we'll see what we get right here. So when we start to see markets at all-time highs, it's just an allocation shift to say, oh, instead of saying I'm out of equities 100%, you know, you certainly could if that is where your risk tolerance is. But if you're thinking, well, I want to be in equities, but just not as much right now because we're at the top end of the trend versus at the bottom end of the trend. Okay. And there's going to be different stocks that are working in those environments. But I would want to say, okay, in this environment, maybe instead of, if this is my portfolio, maybe I'm only, 25% in equities and 75% in cash. Okay. And this level right here is going to help me determine what this should be. If we were at the bottom end of a trend and starting to move back up, then I would want to start deploying some of this cash and putting it to use and getting more and more positions and more trades. Now, the way that we utilize the wheel methodology, this happens relatively naturally, where we're getting stopped out of trades naturally, and sometimes that's an uncomfortable process to have some of the shifts. But in this case, and then as we're adding into new positions, we can just add in with a little bit smaller sliver to the pie, so to speak. You can see, some of these are at less than 2%, and that's by design. And some of these we've just added smaller positions because the market conditions are also very toppy, and we've had that retracement. Now things are shifting just a little bit here where we're at the bottom end. We're still in that real long-term uptrend, and I think we're going to continue to see on directional alerts, this is going to continue to move flat to down, more than likely, something like this, where just because of the elevation. Now that said, we could get a shorter term support. What I want to see right here in the shorter term is I want to see how these markets are going to react to these support areas right here. Okay, so we're now you can see S&P 500 up to 1.23. This is a real high demand zone. We're inside the momentum location still, and we're at the upper end of that long-term bull market. So if we were having a retracement and we were clear back here, okay, we may say even back here at these levels, I'm going to increase my allocation. Now, one of the other things you can do as trends start to increase is, instead of doing, right now we're at probably about 1.75% allocation. Typically it's between 2 and 2.5. But you could maybe, in a real aggressive bull market or early in that trend, say, I'm going to go 3% or maybe 3.5 or 4%, which means that you're just taking on more risk of that allocation in the pie of your portfolio. You're going to take a little bit bigger slice, 3%. Okay, that's risk management. Risk management is determining what percentage you're going to allocate towards that trade. And that allows you to control this portfolio number a little bit more. Okay, and control that risk. That's ultimately what we want to do, is we want to control the amount that we are at risk. And that is essentially how many, what is at risk in this portfolio. Well, this blue is cash. That's not at risk. At least it's not at risk of market volatility or market risk. It has a different kind of risk. It has inflation risk for a long term. We've talked about that. If you're going to hold on to cash, for 10 years, that's an issue. You're not going to outpace inflation. But if you're going to hold on to cash for 3 months, then by all means do it. Okay, there's nothing wrong with that, or even 6 months. Okay, whatever length of time in the short term you're deciding, or that you're going to do something with that capital at some point, but you just are unsure of the risk, or you're unsure of the allocation, then that is fine. That's what cash is for. Just leave it there until or if it's a part of your implementation strategy. This is a part of this wheel strategy where market conditions are they've kind of naturally created this. When markets are really doing well and things are moving higher, we get stopped out of a whole lot less stocks, and we end up holding more and more and more and more and more and more. So we end up with a lot larger number of holdings in a really nice uptrending bull market. So the individual stocks can also tell a little bit more of the story, and as they're winning or as they're losing. And we've had a lot of both this year so far, and this is about the current allocation, just slightly more than 25%, maybe 30%, and 70% in cash. And that's, in my opinion, for this portfolio, that's a prudent approach. For your portfolio, you may want more cash, or you may want less cash. Okay, but just essentially the time frame of the length of time before you actually are spending that money or need that money should be taken into account. And that's this cash pool and this equity pool. Instead of saying, I'm just going to buy $1,000 of this and $1,000 of that and 500 of this and 500 of that. That's fine. That's fine if it's, if you want it to do, if you feel like that's a method. But if you want to be able to know exactly your process and why you're doing what you're doing, where your stops are, how you're exiting, then this is one approach that you could utilize here as well. Let's jump back to some of these market conditions. I wanted to go over what I wanted to cover today. I wanted to cover almost every single one of these. When it says market ETFs, obviously that is market ETFs. These are all ETFs. On the sectors, the sector ETFs, these are all ETFs. The reason why I like to have ETFs here instead of an actual indice is because this is primarily what we're focused on, number one, and number two, they're tradable. So you could say, oh, energy is an uptrend, or even what did we have just recently? Where did it go? It was utilities right here. So I didn't sort this. So we have utilities in this uptrend. If I were to say I want to add the utilities sector into my portfolio and every stock that is included in that sector, then I can just buy one share, one symbol. Okay, I can buy the entire sector right here, and in the 6 month time frame. So utilities have been doing quite well. They've retraced. They've actually been leading us out of this downturn. They had a downturn, and so that could be one of the areas to say I'm going to allocate a certain percentage into the entire sector instead of one stock or two or three or four inside of that sector. I can buy the entire thing. If I have sectors here, you can go to the sector scan and say, okay, utilities, obviously utilities is starting to show some strength right here. It's got a buy-sell ratio of 2.2 to 1, which means this right here. You've got basically 40 to 20. If this were 40 and this were 20, this would be exactly 2 to 1. So that number would be 2. So we're a little bit higher than 2 to 1 because we have more than 2 to 1 winners to losers in uptrends. So this is also confirming that sector. But if I don't know which of these, there's all of these stocks that are in here, 100 stocks or so, at least in this scan, that some are down, some are up. If I didn't know which ones I wanted to utilize, I could go over then and just buy the entire group with the ETF. Okay, the ETF would allow me to do something like that. Versus here, if I were to take it a little bit deeper and really want to do my own allocation, then I could say I'm going to go with utilities. I'm going to click on this 38, and I'm going to go with something here from this top group, PAM. What's it doing? Big confirmation bar, long retracement pattern here during this corrective phase. now some yellow, now some green. It's kind of rounding that corner back up again. That's part of what we're looking for in this momentum strategy is we want to just let this entire piece of correctiveness, live its life without us. Okay, it can do its thing. I don't want to know anything about this until here again. Okay, if we're stopped out of a trade somewhere here, this uptrend starts to fail. We're out of a trade here. We're not revisiting that until it starts to look like this. Even in a lot of cases, until it really gets back up into that momentum zone. But this allows us then to say, I don't care where this has been. I do, but I will not have wanted to ride that out from January to April, going through and waiting for a retracement in a stock like that. So that's essentially why we're getting out of, if we have a stock and it's trending higher, we have a trailing stop loss. It gets us out. We're out of that trade. Now we can move on to something else that may have a little bit nicer setup, or maybe getting set up with a new uptrend. So I can then go into and look, my scans and look for something like this. So it's a way for us to be efficient with the capital as much as we possibly can as well, so that we're not waiting with dead capital. Okay, if we're just waiting and we hold a stock and we're just waiting it out, yes, that is a strategy to just buy it and hold it if I'm buying something that I believe in for the real long term. Okay, but as far as holding on to something because you have a loser as a reason to hold it longer is a bad plan. It's not a plan. You shouldn't have a loser for that long. You've got to cut those. We want to cut the losers as quickly as we possibly can, and then have that determination. So that being said, we go through a certain number of stocks. We're going to get stopped out of winners and losers. For example, HMY. HMY was a trade that we bought. Let me go into that 6-month time frame. Where are you? Here we go. Here's 6 months. It may have been a little bit early. We set a stop loss. We bought right here. Okay, on this, as it was trending higher. We kept adjusting to the 236. Okay, and then we had it set as of yesterday. That stop was set right below that 236. Well, gold gapped lower, and of course, gold miners gap lower, and that exited this trade. Okay, so we basically went from buy here, pardon me, to sell right here. So I think the profit on that was, in fact, let's run and look right here. We can go, oops, where is that date range? HMY profit 25%. So we had 25%. Here's some of the stops we've been stopped out of. We had a small gain here on CDXC that we also got stopped out. -8, -4, -1, -8, +38, -10, -14, -7, +18, +4, -5, -12, -6, +60, +40, -18, +20. This one really hurt right here. That was a gap lower. Okay, but we always use position size. So the transaction size right here it ended up being about $1,000. Yeah, it was profit 1,000. That one, we've had a couple of those that were just, kind of an anomaly, just a nasty earnings. But in terms of the sideways action, you're seeing 27 -15. Those losses, we want to keep those losses. This is about as big as a loss as we ever really want to have. On average, that 12 to 15%. That's our normal stop range. If we're dealing with a situation where we have a big gap, then we have to manage for that with position size. And that's why we're using little smaller pieces of the pie here, because we're trading relatively, they're pretty aggressive stocks. We've had some that have they've really done well, but when they move lower, they move lower quickly. Okay, so as a part of the strategy, the risk management is that we have to go smaller position sizes, because we might end up with a scenario like this at any time. Okay, any of these could happen. This was a real bummer too, because this one was really flying high and doing well, but its earnings caught up to it, or lack thereof, and that happens in uptrends. So my point of this was that stop outs are not a bad thing. Okay, even with HMY, we were stopped out, but it was a winning trade. Overall, we still made money on it. Now, are we ever going to make as much as we possibly can? It's hard, because you're dealing with two things. Okay, you're dealing with should I have sold into strength here? Okay, should I have bought here and sold here? Should I have bought here and sold here? Okay, where and why am I going to sell on the way up? Okay, that's a harder game to play. This is still a little bit harder game to play, riding out a retracement, having where we were maybe up 40% and ultimately gave back a bunch and ended up with a profit of 25%. This range is our range of volatility that we have to be okay with. I need to come up with some kind of a name for it or something, but it's basically, it's basically kind of our crazy zone right here, because we have a stock that's it's topped out, and we're willing to allow it to come all the way back to here in order for more upside. And sometimes that doesn't happen. Sometimes we get stopped out here, and typically that trend is over and it'll retrace, and maybe it'll find some support here, maybe it'll find some support here, and then it reverses back up, just like that chart of PAM that we were looking at. We've just got to set rules in place to manage that risk, and then follow those rules and trust those rules, and realize that another stock is going to come along. That's the whole point of what we're doing. Is we don't want to get stuck with like we're missing out, or like, oh man, I thought gold was, I'm reading all these things that gold is going to go to 5,000. Shouldn't I be in gold stocks? Well, that's a different method. That if I'm going to buy and hold gold stocks, then I'm going to buy and hold gold stocks, and I'm going to let them be volatile, potentially up to 30 or 40 or 50%, but I'm in it and I'm holding it. That's a different method. In this case, we're a little bit more active, not too active, but we are doing something just about every day, and that for a lot of people is quite active. If we're spending a half hour a day in managing trades, setting trades up, adjusting stop losses, and really that's the core of the management process that we're doing, is looking for new entries. Okay, setting up our risk profile in that new entry, which is this here. When we're adding into a new stock, we want to say, okay, I'm going to buy this stock. How many shares should I be buying? Okay, and I decide, well, if I have 1,000 shares, that's 8% of my portfolio. That's too big. If I go 200, 1.6, that's about right for now. If I even went 250, that's our 2%. So we go 240, there's our 2%. And a stop loss, if I were to want to buy this stock right now, let's say I had an 820 stop loss, that's a pretty tight stop, but that's what I mean by my risk profile. These are the two numbers I want to know before I ever set up a trade. Okay, I want to know this number, portfolio at risk, and I want to know position size. Okay, position size. This changes with a stop loss. So right now we have our stop loss in place, 820. If I delete that, so typically the way I'll start this is I'll start this out with this blank. Stop loss, stop price is blank. That tells me my portfolio at risk with the entire allocation. So this is a 2%. It's a 2% at risk, which is on 100,000. Obviously is going to be right at 2,000, and that is with zero stop. So now I can say this is worst case scenario. Worst case scenario is something happens and this stock gets wiped out. I'm down 2%. I'm out 2,000 of my 100,000, or I'm down 200 of my 10,000. Okay, whatever these numbers, whatever this number is, doesn't matter. These percentages are going to give you the right number that you should be risking based on any positions, any account size that you have. And that's just, you're just going smaller, so less shares, 24 shares instead of 240 shares. You can do the same thing, and let it be one share. If you're brand new or just wanting to be active but just don't want a real big position sizes on at any given time, then there's absolutely, with most brokerages now, they have zero commissions. Buy one share of the thing, and trade $8. And so you're watching that stock and it's moving up and down, and your volatility, and you buy one share at $8 and that goes up 10%. You've made, if you bought 100 shares at this, if you bought one share at $8, you're talking about pennies that you're watching in order to learn. Okay, that's a live way to learn with real trades. And set up your stop loss, use a trailing stop, Understand what that feels like as you need to adjust your stop loss that day. Okay, don't do it with a big amount until you earn it. You've got to earn the position size by your confidence level, your management level. You're not forgetting to set up your stop losses, or you're entering something wrong, or you realize, hey, I don't have a clue what I'm doing. I need to slow down. Okay, that all of those things, I've experienced every single one of those things. So if you haven't yet, you will. Trading is mostly about you and your risk tolerance, and the ability to follow a system is key as well. It doesn't matter if it's this system or any other system. If you don't have a method to the madness, so to speak, then it becomes madness. At some point, it becomes scattered, it becomes sporadic, it becomes, you don't know what your risk is and why. You don't know, you get emotional and stressed out and fearful, all those things, which, most of us deal with that anyway. We don't want to add more to that. So we can have some structure and a little bit more control over that setup. We don't have any control over the outcome. We only have control over the setup. Okay, so when we're going in and we're seeing stocks and we're deciding, hey, I want to be able to take on, a trade, VIST. We're seeing oil having some nice moves here. So we're seeing confirmation bar, entry, how many shares. I come here, I choose my portfolio. In the portfolio, if you haven't, and you could do this, is set up, just go in and add a tab and set one up and just name it a dollar amount. And if it's close to your overall portfolio, or obviously if you're tracking your own portfolio. But my point is, if you're just doing a quick analysis and approximately what your portfolio size is, and you say, hey, I want to look at this stock and I want to see about what it would mean, then you can just grab that number and then you can start plugging some in and say, okay, what does 1,000 shares look like? Oh, that's too big. Okay, what does 10 shares look like? What does 50 shares look like? 2% of 50 shares based on this amount. Now I could adjust my stop loss, or at least look to where my stop would be. Maybe it's right down here about $38. So let's plug in 38. That's $184. That's 0.1. Okay, our acceptable level, at least my acceptable level for this portfolio is 0.3. Right now it's 0.3 or less. Okay, so anything that's less than 0.3, 0.18 is less than that, I'll take that. If it's higher than that, then we want to adjust that either by adjusting our stop price or adjusting the number of shares. Okay, watch this number when I make that change. Okay, so right now, if I wanted more risk, but I don't want to adjust the stop loss, okay, then I would increase my shares. If I increase this from 50 to 80, notice that took that number up. It's because I have a bigger position now. My stop loss didn't change, but I have more shares. So now, instead of, my position size now is 3.2%. That's too big. Okay, so I also don't want to have that big of a position by going too big. So and I forgot what my stop was. Oh, 38. So 38. So even if I'm acceptable at risk with a stop loss, my position size is too big. Okay, so I want to manage both of those. So now I've come back down. Now if I get rid of that, position size is right at 2% with my 38 stop. Boom, $184 at risk on this trade. It ties up a couple of thousand of my 100,000, and I set up a stop loss. Review that stop loss at least, typically once a day is all you need. Every morning, adjust your stops if you need to. Most of the time, it's about once a week. I think we end up adjusting a stop loss as it's moved a little bit higher. You don't necessarily have to adjust it every day, but that's a quick way to be able to go through that risk process and to be able to understand, is this something that I want to consider? Now, going back to the ETFs, it's the same story there. If I were to buy, let's say, let's go to commodities, and let's say I want to buy oil right here. It's retracing, it's right in the middle. And if I wanted to buy USO, I could do the exact same thing. It's just like a stock. And so I would want to consider that like a stock. It's not going to move in terms of percentages. It's probably not going to move as much as a stock, which may be a good thing in this market right now, or for your own risk tolerance and your own ability to handle volatility of an individual stock. If I went, what's that priced at? 80. So let's see what 50, let's see what 30, let's see what 25. So 25 shares of USO puts me at 1.19, 1.9 rather, and that's with no stop loss. If I set my stop at, let's say 77, the reason I chose 77 is it's just below this low. That yellow is a little bit hard to see, but it's a bullish, it's a rally, it's a retracement, it's finding support, 236, prior support, confirmation bar. We'll see if it lasts and if it stands. So in this case, a $77 stop, I'm at $69 at risk. 0.07. Okay, that's right now. That's a pretty tight stop based on where the price is as well. So I could even widen out the stop if I wanted to just a little bit, or leave it where it is. If I'm fine with that, you know, and I'm wanting to risk that amount for potential upside of whatever for crude oil, then that's how I'm understanding my risk. I want to understand the number of shares. I want to understand my my stop loss, and ultimately my portfolio at risk. And then I can own USO, or I can own gold, or I can own, you know, the US dollar if I wanted to buy a currency ETF, or I can buy wheat. Okay, if I wanted to own wheat, I just saw that was moving here recently. Where was it? Wheat right here. So wheat the last couple of days has had a big run up here. Okay, if I wanted to buy into the price of wheat, the commodity of wheat, without buying the futures itself, I can buy it through an ETF. In this case, the symbol is WEAT, and then I can own a piece of wheat as it's going higher. Um, if it is going to continue higher, but it is bouncing off of a bottom right here as well. So that there's ways to be able to participate in lots and lots of different ideas without necessarily having to either buy the futures contracts or by buying an individual stock. If I wanted to own gold itself, I could certainly do that by owning that sector ETF commodity GLD. Okay, GLD. If I wanted to own steel, I could own steel, the price of steel right here through this ETF. It's kind of moving, gapping about a little bit lower. It was holding up there for a little bit. It's trying to move back. So ETFs are a good tool. I don't use them a lot just because, you know, I think the stocks and managing stocks and using that methodology for my style is effective. But ETFs are a fantastic tool for less volatility and a structured way to control your risk, just like a stock. Because with the ETFs, we can do the same process. Doesn't matter what it is. If it's a market ETF like the Dow, let's say I just wanted to go in and buy the entire Dow Jones Industrial Average right now, DIA. I go in here, I determine what my number of shares are, and that's pretty expensive. So we go down 10, let's go 7 shares. Goodness, I'm not going to get many of those. So 1.85. If I had 5 shares and a stop price of 375, okay, now I can buy the Dow, and I've got a decent sized position, a stop loss at 375. That's $50 at risk just for buying the Dow. Okay, I'm buying and owning a fraction of what that particular commodity or particular what's the word I'm looking for? Apologize, exchange or indice. No, it's not exchange, the indice, the Dow. Okay, so ways to use ETFs if you're not familiar with them or utilize them, something to consider for you for this week. That's going to do it for today's update. Appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Bye now.